The main question you need to ask yourself is, who is getting the payment? Where is the money flowing? And is the money re-advanceable? Can you re-borrow from a bank if you pay a mortgage?
Today, we are having a call to ask us anything regarding infinite banking concept as you relate with real estate investing. One question always come up is, what is the rate of return? Why am I putting my money to this concept?
A great question. We get that quite often. People ask us about rate of return. And then, for me, I answered it pretty straightforward. I go, using this process is not about an investing of any kind. It's about capitalization. To me, it's always about building a pool of capital that I can access for whatever I need in life. And if Allison says, how much of the banking function do you control as it relates to your needs? And so if your need is to purchase real estate, then how much of that capacity do you have within your means?
We have to look at this as an asset. So we're enhancing what you are already doing. We're not talking about stopping real estate investing and doing what you love, because real estate investing makes a lot of sense and it is very profitable. But it's about how can you make that process that you're already doing so well just that much more better. And this is about enhancing that process and taking control of the financing function as it means to funding for real estate when it comes to garnering capital, or how you are actually funding your deals.
As a real estate investor, that was actually one of my first questions when I find out about this. The thing is, when we talk about infinite banking concept, many of us know that the tool that we use to practice becoming your own banker is through a specially designed, or we should say properly designed, participating, dividend-paying whole life insurance policy. So when we are having a policy, a lot of people looking at the premiums to a policy as a cost. Thus, people having this zero-sum kind of mindset saying that, hey, if I deploy my capital into this premium, that will hinder me using this capital for real estate, right? This will hinder me using this money for a private lending deal. So we're comparing deals. As real estate investors, a lot of time, we doing a lot of our due diligence to look for where is the best place to deploy our capital for the investment. Becoming your own banker has nothing to do, has no conflict with any of your deal searching, because it is not an investment by itself. It is about how you go about investing that deal.
Can rental income pay premiums for your policy and then use a policy loan to pay rental expenses?
But the answer is absolutely. You can use your rental income, obviously your net income that comes in, your profits, right, towards a policy. And then you could designate that policy to use for expenses related to that rental property, as an example. And really the opportunities or the possibilities are endless, but that's definitely one way you could do it. My wife and I take advantage of our policy system by taking out a policy loan to pay for the home insurance annually, which gives us like a 6-7% discount, which it's a decent discount. We view that as a return, right? Because we're saving that money. And then what we do is the same monthly payment that we would have otherwise been paying monthly to the home insurance company, we put that monthly payment back into our policy loan. And so by the end of the year, we would have replenished that policy loan amount. In fact, we would have put a little more than that. And then by the end of the year, we can repeat the same process again.
When Nelson says infinite banking is an idea of logic, imagination, reason, and prophecy, it's just interesting how the question was, can rental income pay premiums for your policy and then use the policy loan to pay rental expenses? And from that, you were able to use your imagination and do something totally different from it. So that's an idea for everybody who's into investing and is opportunistic and thinking ahead of the game and looking for the next opportunity, that once you have a grasp of the concept, you can then have your imagination start working for you and seeing where this process can actually enhance what you're already doing. For example, insurance or property taxes or rental income, whatever the case may be, right? So that's just an exercise that I thought was really interesting, Taran. Like, what else can you actually capture into your own system?
Once you get into it, your confidence, and to jump on what you were saying, Sukhman, your capabilities, yourself and your system's capabilities will grow, and then it can handle more things for you. Does it make sense to pool available funds into one policy to start the process, or does it make more sense to spread the available funds across 4 policies? Just wondering if one approach is more strategic than the other. That is also what part of our process that we would go through when we meet with you. We would dive into your circumstances. We don't follow a template approach of saying, everyone, we're going to do it this way. Depending on your specific life journey and where you are in terms of your financial situation, we may evaluate something. So I may look at a particular situation where this particular individual has a good amount of, part of the process that we do as licensed life insurance advisors is also evaluate your insurance needs. So maybe it is important to put life insurance policies on the full family. In terms of practicing the process and achieving goals and objectives that we go through, I would look at a specific family and say, okay, the family's nicely well insured, but in terms of achieving the goals and objectives in the time frame that the family's looking for, maybe I'll just concentrate the policies on one individual and then maybe some on the children. Whatever the goals and objectives are, that's where part of the designing process in our meeting would entail. So to answer your question, it varies strategically and it is very individualized when you go through the process that we go through with you.
Is it only the participating whole life policies that we use in infinite banking concept? Is the cash flow not available at the end of first year of the earnest? So the answer is proper designed participating dividend paying whole life insurance policy is the best tool to use as infinite banking concept. When you open up a bank account, do you want to have guarantee or do you want to have a risk on your capital? Cash value is available right away when your policy set up and depend on how you set up. So you don't have to wait at the end of the first year. Almost right away, you can access fund.
I have a client of mine who has a universal life policy. And because of the performance of how that policy was structured, it was not designed for practicing the process of infinite banking, but this is pretty common in what can happen in a lot of universal life policies. If the fund is not performing well and the premiums that was being sent to maintain it wasn't enough, then it puts the policy in a lot of danger to collapse. And actually, his policy was under that type of situation where he was sending pre-authorized debits in the form of premiums for the universal life policy. And it was not enough compared to the value of what was sitting in his universal life policy. And the question that he had to me is, what do I do with this, Henry? Should I cancel my policy or should I continue funding the amount of money per month on that? And the question, unfortunately, that I had to share with him is, this is actually a question you have to ask yourself. Do you want to continue committing funds to this situation or do you want to exit? These are some of the realities that we deal with when people work with policies structured this way and not using what we use.
What is the process for getting a loan from the insurance company and the time frame?
That depends on the insurance company. And each insurance company has a different experience. The one that we use specifically is a mutual insurance company. The experience to practice the process of banking and accessing a policy loan is a very simple and encouraging process where once you have a policy, you will have a portal that you can log into to see your values. And every day when you look into the values, you can see it increase. And you will also be able to access a loan through a press of a button. There's a few very simple steps that you go through to understand what you are going through in terms of accessing that loan. Once you've declared how much it is that you want to access and you've set up your bank account with the particular insurance company, within 7 to 10 business days, those funds can be deposited into your bank. So that's just as easy as that. No income verifications, no qualifications. You get to decide and set the terms because you are the banker, as it is when it's becoming your own banker, on when you want to pay it back, how much per month you want to pay. If you aren't able to make a payment, you won't get any threatening phone calls, threatening letters, or anything along those lines. So this is the process of becoming your own banker and getting the control back into your hands.
As a real estate investor, I really love the privacy part and also creditor protection as well. So that's just an added bonus based on the tool. Isn't the interest on policy loan much higher these days as they are based on prime rate? So how does saving 6% on insurance payment by using policy loan make sense now?
The interest rate on the policy loan is not based on prime. In fact, the interest rate in the last couple of years actually only increased by 5%. So before it was 6.2% in the insurer that we used and we're using most frequently. It used to be 6.2%. Now it's 6.5%. So the increase is only 5% increase. where what is the increase in the bank rates for the last couple of years? Let's say they charge now like 1.5%. Now they're charging how much? I think it's like 500%, right? So we're comparing increase in their rates, bank rates, 500% versus 5% in the insurance company, right? So it is right now more favorable in terms of the insurance company. By the way, if you haven't read Nelson's book, you have an opportunity today to read Becoming Your Own Banker. So what Nelson would say, it's not about the rate. Rate is not giving you the truth. You need to look at the interest value, not at the interest rate. Because comparing rates is not giving you the 100% truth, because you're comparing different mortgages. You're comparing different rates. One rate may be related to a mortgage, which is a structured loan, and the other rate may be a simple interest, and it's a total different thing, and they work differently, and the amount of interest you're paying may be completely different. So it's not about arbitrage. Many people think that borrowing from insurance company and saving interest is an arbitrage, and you borrow here at 6.5%, and that's saving you 0.5% arbitrage. It's not. The main question you need to ask yourself is, who is getting the payment? Where is the money flowing? And is the money re-advanceable? Can you re-borrow from a bank if you pay a mortgage? You cannot, unless it is a HELOC or other type of simple interest loan. But in simple terms, you are not saving 6% on insurance payment, Varun.
Pauline also asked about a flow chart, a diagram to share a visual. If you think about using an example about our traditional way of getting a down payment or going by a real estate or a investment, one way is we will save money in a vehicle, your checking account or any account, but that money is in someone else's banking system. Once they save enough money, what we do is we withdraw that money to go buy this investment, correct? Once we withdraw that money is gone from our family forever, right? And then you're going to slowly build up your pool of capital by your positive cash flow or your other incomes. You slowly build up, and then you get to where you were before. So from a money flow point of view, our money is not growing in this case. Some other ways for real estate investors to buy deals or purchase deals is by borrowing money. When we borrow money, we get this money right away. We can go for this deal, and it's not our own money. We all know it's other people's money. But when we borrow money, we have to pay back the loan, right? So we have to pay interest, no matter it's your own money or your home equity line of credit or someone else's money or some other bank's money. You have to pay interest going back. So once you pay off this bank loan, all you achieve is your loan gets to zero, but all those time, all the financial energy goes to someone else. So what we coach you to here by Nelson Nash's coaching to become a wealth creator is we want you to build a line, the green dotted line, that your money is always growing uninterrupted. And at this time, if you wanted to do a deal, say $50,000 down payment deal, you can borrow policy loan by using this red line representing here, where your money always continue to grow.
When paying back the interest of the policy loan, would this payment be designated as a paid-up addition? If not, could a situation arise when one inadvertently carries over interest into the next year if instead one fully pays into the paid-up addition room instead? So there's a couple different questions in one question. First thing is, I assume that Jeffrey is asking about situation where you do have available room to pay for paid-up additions, to buy paid-up additions, which you haven't used fully yet. If that's the case, when you took a policy loan and you're paying it back with this particular insurance company, because remember, not every insurance company will allow you to buy paid-up additions throughout the year. The company we work with allows to do that. Throughout the year, you have option to buy paid-up additions. So when you pay, you need to specify if it's going against a loan outstanding or if you're buying paid-up additions. You need to either let your advisor know what to do with this payment, or you need to send an email to this insurance company and ask them to apply it correctly. And then you need to watch how it is applied and make sure that it was correctly applied. If not, then you need to reach out to your advisor. Second thing is, if a situation is possible where one would carry over interest into next year, meaning next year of the policy, not necessarily next calendar year. Or you should be watching to use your available paid up addition room instead. First off, I would say don't be afraid to carry over the interest, because who is the banker in your life? Yourself, right? So who are you paying interest to? Are you paying interest to a bank and then you never see it again? Or are you in a driver's seat and this interest essentially go to the insurance company, but it adds to the profitability of the insurance company, right? So it is okay to actually transfer interest to the next policy year. And if you're a real estate investor, you need to understand that you actually can re-access this policy loan when you pay interest. But answering your question is, yes, it's better to actually buy paid up additions first and then use up that room. And if you have done it, it's great. If you have not, yes, that's possible that you'll be in a situation where you haven't used the paid up addition room and you didn't look at where your policy payment were allocated, and you paid interest off or paid interest for this year, but you didn't actually care about buying paid up additions. It is better to buy paid up additions first because you only have a specific window to use this room.
That is a very kind of case specific. What's going to work for you and what are your objectives? In some cases, you may not want to lose any of the dollars because you have a specific objective for them. So again, it just comes down to you being in control and you being able to decide what's going to be best for you in that circumstance.
So Markin asks, Howdy gang, just had my third party at home nurse assessment for my first policy. My question is about a leveraged strategy I was thinking about using to invest in real estate. Let's hypothetically say I borrow $100,000 from a HELOC at 8% and I place it into my policy. Then I borrow from my policy at 6%, which gets a wash from the dividend to invest in a private real estate investment note at 12%, which I then use to pay the interest back to the HELOC. Would it be wise to keep the capital working for a positive spread as long as possible? Or should I plan on having that excess interest cash flow or a certain percentage of it go back into the policy as quick as possible? A lot of the ways that we use, practice the process of banking is to help us recapture debt. And when we recapture debt, the goal is to get out of the debt. Now, if you're borrowing $100,000 and to put it into the policy, you're kind of reversing the purpose, because when you took credit dollars to fund the policy and then taking the policy loan to pay back the credit, it's kind of in a not winning situation. And so we don't want to go into that type of an environment. But your second part, where if you've earned funds and have it residing in someone else's bank and you are putting it to fund the premiums of the policy, now you are using the funds to invest or issue a private loan with terms that you've set at 12%, fantastic way of being the banker in the situation. So the only component that I would just suggest is not to borrow funds from the HELOCs to fund your policy. But if you want to use the policy to participate in private lending, by all means, that's an excellent, in my opinion, a good way. If you are able to structure something like that and find someone to take on that type of loan, then that's your opportunity. That's your unique ability, by all means.
Can you write off interest if you use a policy loan to fund your real estate project through a business?
The technical answer is yes. My opinion in terms of whether you should do it is different or varying on situations. And I would say it would be more helpful once you have the policy in place to then explore that with your coach.
Is it a good idea to access policy growth to purchase a rental property? Yes, you can. I would say when you access your policy, which means when you take a policy loan to purchase a cash flowing or cash generating property, as long as you have a plan to pay back that policy loan, I would say that's great.
For those that have successfully transitioned to being their own banker with this system, what other active accounts do you still maintain with the major banks? Is the debit account the only required account to utilize spend where you need? Eventually, if you can build up your system to a point where you can funnel all your income through the system and then use it to fund the big expenses in life, that's great. It's going to take time to get there. So the bigger picture can be daunting. It's about first working out how can we start the system. The second thing is, again, it's not a either or. Should I do infinite banking or should I do this? So in terms of recommending whether or not you should just do this, we never say to anybody that you shouldn't use, for example, a HELOC to invest into an opportunity if the opportunity arises. So it's not a bad thing to have that option available to you. if you have the HELOC there, to not miss out on an opportunity to invest as a real estate investor. That's how I would answer that question there. How do you manage monthly utility bills based on their frequency? Is this incorporated in your own banking system or not? I think this question, the best way to answer it is, it depends on you. It depends on what your amount is that you're comfortable with funding through your system. So for myself, a rule that I have is I like to only fund purchases that are $2,000 or larger through my system. I feel anything lower than that for myself, that's a place that I like to use my credit card and pay it back, or use my own cash to pay off those amounts. So that really does depend on where your system is and what the rules are that you set in place. And that's the beauty of it. You are the banker. You get to decide those things.
What has been circumstances in which your clients decide to put their policy loans as collateral for a down payment instead of taking out a policy loan. And if you build up enough cash value in a policy over time, you can actually collaterally assign it at a commercial bank, and you could use that for a down payment instead of taking out a policy loan. Each case is going to be dependent on the person. I've been practicing since 2014. I haven't collaterally signed any policies. I don't have any plan on collaterally signing a policy in the short term, because I'm still able to stay below my adjusted cost basis, and I'm going to work with a life company before I'm going to work with a commercial bank. But I have seen cases where people have put their policies up as collateral assignment, and it's a good conversation to have with your coach and just go through the pros and cons of it all and make sure you understand it before you do it.
I personally has not planned to collateralize my policy with a bank. Is number one, that I try not to do business with bank. Secondly is I do want to keep my policy private at this stage. That's a decision that you have to really consider a lot of different factors. That's a great personalized question to ask your coach.
Is it better to have more than one policy, for example, one for real estate investment and another to finance one's own property? Absolutely. This is not meant to be done in one policy. Everybody has different needs and financing needs. And for some, a few policies may do the trick. It is a case-by-case basis, but having an objective for a specific policy is a really, really great way to get started and add on as you're able to.
What are the possible issues and threats that may arise in a total economical crisis or market failure in conditions in drastic levels and or lengthy periods? One thing that we can just say is you are going to need to practice the process of banking. Do you want to practice the process of banking at the you and me level, or do you want to use the current banking system and rely on that banking system? The second part is, in terms of the insurance companies that we use, they've existed in Canada for over 100 years, which includes World War I, World War II, the Great Depression, multiple recessions, pandemics. Irrespective of the economic environment, the insurance companies that we use have never failed to generate a profit and provide a divisible surplus to the policy owners every single year. Now, if you ask me, at least from the track record, that to me shows a lot of confidence that I would place it.
Is there an upper limit for a whole life insurance policy?
There is a limit based on your income, and you just need to talk to your advisor in order to see where the limit is. And let's say you hit this limit at some point, right? So can you put insurance on your family members or maybe business partners? Yeah, you can do that. So in terms of premium, again, the premium is also dependent on how much coverage you're buying, and the coverage has limit on your income.
It's hard to hit the limit. Again, you wanted to make sure we all have insurable needs, right? So that there is no limit on the number of policies you may have, but there might be a limit on the total death benefit insured based on your assets, based on your incomes. When considering the amount of interest you plan to pay back to a policy loan, how do you determine whether there is more benefit to set up a lower rate and use any extra fund to generate another policy?
The life company is going to set an interest rate. And so you get the opportunity, and Nelson taught us, to pay ourselves at a higher rate than what the life company's asking for. Now, the key thing is, with the incremental amount that you're going to pay back, that needs to go into premium somewhere. So if you don't have the ability to do it within that particular policy that you have, then it makes sense to look at, can I start another policy? So the first thing is, when you're paying interest back, the life company's going to set their interest rate, pay that. If you're practicing what Nelson taught and you're paying yourself more, find somewhere to put it in this premium, because that's what he taught. And if whether it means you have to start another policy or not, that would be determined by your circumstance.
So depending on your situation, Dan's right. This may be a good idea for you to actually implement this, but it may be a good idea to actually start flowing your cash flow through your system and start paying back some of that debt and freeing up some more cash flow for yourself, right? So again, I would say exactly what Dan said. Speak to your coach about this and see what strategy can be created by working together to help you reach your specific goal and the purpose of why we're starting this banking system for you.